It's November, and the national housing market finally has a little bit of movement and a lot of noise. So let's cut straight through it. Here's what is actually happening right now. Mortgage rates are finally behaving. Rates have been drifting down for most of 2025, and not because the Fed is gifting us anything. It's because mortgage spreads have finally come back down to earth. That improvement is why we're sitting near 6% interest rates, rather than the 7s and the 8s that we saw last year. Without that shift, the market would still be frozen. Additionally, demand is waking up, slowly, but turnover is still at rock bottom. Only 2.8% of homes in the entire country have sold this year. That's the lowest turnover rate in decades. Why are we seeing that? Well, it's because of three things. Prices are still high. Borrowing costs are still elevated. And most homeowners, they're still locked into a rate under 5% in their current home. People do want to move. Life happens. But they're not giving up a 3% mortgage unless the math or the motivation is strong. Here's the shift. The lock-in effect is weakening. We're seeing more homeowners with rates over 6%, and that changes the psychology. The longer people stay put, the more life pushes back. New jobs, downsizing, upsizing, getting married, having a baby, being closer to family. These things that are happening, that's loosening inventory. National listings have climbed every month this year. Remember, it's national. Affordability has quietly improved. I know it doesn't feel like it, but the data is clear. Payments are down from their peak. Rates are down from their peak. Seems like wages may be rising faster. The share of household income needed for a typical mortgage is the best it's been in more than 2.5 years. That's important. Inventory is building, and that's healthy. We're not in 2020. We're not in 2021. Homes are sitting on the market a little longer. Price cuts are a little more common, and the frenzy is long gone. But this is not a crash. It's a normalization, and we need that. National prices are basically flat, but it really does depend on where you live. Some markets are up 3 or 4%. Some are down 3 to 6%. But nationally, we're hovering right around 0. So the translation to that is this. It's a local market story. Some areas are competitive and others are correcting. The forecast for 2026 is steady. Every major forecaster, Fannie, the National Association of Realtors, the Mortgage Banking Association, Wells Fargo, even the bearish ones, they're calling for mild depreciation next year. Not skyrocketing prices and not a total collapse. Seems like we'll be somewhere in the 1 to 4% range. And remember, the market isn't stagnant. Even in a year with the lowest turnover in 30 years, more than 11,000 homes still sell every single day in this country. Buyers are buying, sellers are selling, but they're being more thoughtful. And really, that's not a bad thing. I welcome a little bit of sanity. So that's where we are in November 2025. Rates are trending down, affordability is improving, inventory is rising, price growth is leveling off. Early signs of a more normal, healthier market. If you'd like the Central Jersey breakdown, what's actually happening in, say, Bernards Township, Basking Ridge, Bridgewater, Long Hill, Bedminster, let me know. We'll send you that information. I'm Jen Blanchard with the Blanchard team. Your home is our business. And if you like the information that I shared in this video, please subscribe to our channel. Click the little bell. You'll be notified every time I post a new video.